Good afternoon, everybody. Welcome to the Stock Market Brief Show. Yes, it can get worse, but there definitely will be dip buyers. We're going to talk about that on today's Stock Market Brief Show. As we know, the market sold off hard and fast on Friday, given some news catalyst regarding China, Trump, and tariffs. So we're going to dive into that in today's Stock Market Brief Show, but more importantly, not just talk about what was said, but there was things leading up to this that led us to believe that the market could obviously come off. But now it's more important to understand where the market could potentially go to from here and what like an extreme move would actually look like in these markets. And I'll share with you some of the signal charts that I use. I'll share with you some of the gamma exposure, the market conditions, and just get an overall good glimpse to prepare us for potential further downside and potential strong moves back up to the upside. So let's go ahead and hop right into it. All right, everybody, welcome back to the show. The VIX shot off like a rocket ship, and the markets sold off pretty hard there on the last trading day of the week. The Nasdaq was down almost 4%. S&P 500 finally had a day that was greater than minus 2% to the downside, which I'll show you. That's been about 120 trading days since we've seen something like this. If you look here at the 11 sectors that make up the S&P 500. Consumer staples ended up finishing up slightly, right? Relatively unchanged. Utilities, you have real estate, healthcare. So you got some more defensive type posturing towards the higher end of the 11 sectors that make up the S&P 500. Towards the bottom, consumer discretionary, technology, and energy down there too as well. There was a record liquidation, apparently 19 billion liquidated after that tariff shock in the crypto market. So a lot of these crypto equities, crypto itself, currencies, altcoins just got absolutely hammered and blasted. So just be very careful when it comes to managing risk. You can't get lost in the sauce without understanding that yes, there is risk still in these markets, and they can happen. It can happen very fast. It can happen slow, but when it actually occurs, it can happen very quickly. So this was the tweet. I'm not going to read this off or go through this. Now remember, leading up to this event, there have been divergences in these markets, whether that's breadth, whether that's sentiment. There has been interesting things from a volatility perspective, from systematic perspective taking place, leading us to believe that, hey, we're not that far away from some sort of a volatility type event. All we need is a catalyst. And what I'm noticing out online is a lot of people are just saying this is what caused it, right? This is the reason why we sold off 3%. No, the reason why we sold off 3% is because the markets was set up to respond to a catalyst in a very aggressive manner. So the catalyst came and then the market responded, and we'll walk through what some of that looks like and how it could still get really worse. It really can, and I'll explain it not by just a narrative, and that's not what I am planning to have happen, but I'm going to show you the charts and the data that suggests that it can still very well get worse. Okay. So yeah, the Trump tweet came out over here. Obviously, this is a big day. It's engulfing quite a bit. I wanted to highlight this over here. This is when we had the trade. It was a historic deal with China. That was when that news came out May 12th from the White House. And we saw a big gap up, some follow through, came back down. And that's what really kicked off getting out of all of this volatility. And now, right, we get this news here, this catalyst, and the market responds, just as aggressively, right? This was a big move down. This was a big move up on the day. And it did lead to some follow through. So we'll see here if, we get, follow through to it, and I'll kind of explain my thoughts, or if, they're going to do something really quick to fix this. If we continue on, there was also some more geopolitical risk around Russia and Ukraine. Apparently there was another attack there. So we have geopolitical risks, we have tariff risks, we have all kinds of stuff going on in these markets. And we got to look at, those systematics and all these flows too, because it can amplify just about everything. If we zoom in Friday's price action, if you just look back to the left of the screen, it's basically engulfing an entire month's worth of trading. And this is typical in these type of low vol environments. You get little small days up, and then when volatility hits, it can wipe out 6, 7+ days. In this case, it was like 30 trading days. Now, when we close at the lows, it's one of two things are very common. Okay, one of two things are very common. When we close at the lows after a big day like this, you break down further and you get some follow through, right? So we make a new low. That's very common. Now, for whatever reason, if we gap up, it's also very common on big days like this, big range days, to have inside trading bars. Okay, so that's what I would be paying attention to for Monday's trading session. Interestingly enough, so Monday it's a holiday. The bond market is closed, but the stock markets are going to be open. So just be aware of that. This is obviously a very big trading session. So if I pull up up, when's the last time we had a, 2% down day? That was over here, which just so happens to be also the trading week. So our expected move when I go over it, the expected move for this next week is as big as it was over here. So that was the last time it was this large. So got a lot of range of volatility to potentially take place, and we'll walk through that. But yeah, as you can see, we had over 2% down day, and the last time was quite a while ago that we've seen this, so about 120 trading days ago. Now, what happens after you start to see big volatile days? Well, it doesn't take a rocket scientist to pull up a larger term chart, look at the 1-day rate of change over here, and this I'm just highlighting where we're minus 2.71% on the day, which is a big day. We haven't seen that really since the bottom here of April of this year. But if we go back and we just take a look at all the times, right, that, it's happened, right? If you just look at these days, look at these days, look at these days, look at these days, over here, there's something very important that you should notice on this chart when you have big down days. They're typically what? Surrounded by up days of the same magnitude, right? So you see right down here, right? You had a 2% down day, over a 2% down day, and then what's over here? A 2% up day, right? Over here, right? Big down day, and then you not too long after, you have a 2% up day. Right over here, 2% plus down day, followed by what? Big days above 2%. Same here. Boom, 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 right? Boom, and then boom, right? So, and then even right here, boom, boom. So they're typically, when you get volatility, it's not just, market go down, market expands in both directions. So this is just something to be aware of as we kind of progress forward. Now, I've been sharing this chart the last couple of briefs, and we've been talking about some of the gamma levels around 6,700, 6,800, 6,750. And, when we slip through 6,700, it can open the door right down to 6,650 in these lower ranges. Went through that, right, and continued down to close towards those lows of the trading session. So we're now at the lower band, which we haven't really been there since September, and then also in August. And from those levels, we typically do bounce. I will notice that the upper band didn't even come off, so it's not even pointing down yet. We'll see what that looks like on the next trading session. And then this one did come off a little bit. As far as this yellow line down, here goes what this is, just a 3-month trend, and that's roughly at about 6,500. If we go ahead and look at some of the key levels to watch for follow through, these are the levels that I would be paying attention to for this month and this quarter. Okay, so down here is actually the quarterly implied move. It's just slightly under 619. This is what the market priced in for the entire quarter. And now the reason I bring this up is because the SPX last quarter finished literally to 25 cents on the money of that upper expected move. Okay, so down here, right? If it mattered prior in the past, it could matter in the in the future. The reason why I have this highlighted also is because it's kind of a zone where we saw prior highs here too. And not only that, if you measure the anchored VWAP from this swing low over here, right, if I do that, it'll go just slightly underneath this, but then I just kind of handed it off to here because we haven't had a touch. So, if the market were to come off more, this is what, about 8 to 10% of a drawdown, which is pretty normal to have happen, once a year, sometimes twice a year. I would be paying very close attention to these levels down here because still structurally speaking, we'd be still in a bull market, right? You'd be just back testing these prior breakouts, which we haven't really done yet. So I'd be looking at there. Now, the month to date for just this month of October, it's roughly about 640. That's what the market priced in for risk. And that you can see is kind of where we prior had resistance here, and we kind of just doodle around these levels. Now, the reason why you're seeing the green and red on the screen is I know a lot of people like to see this indicator when it changes sometimes. It hasn't changed since early August, right? Where we had this kind of big down day here, and what had happened was the market kind of just continued to press higher, and we saw this obviously big aggressive. So the market, since this sell signal that I have for larger term trends, the market's up about 2% after today's price action. This day most similar reminds me of back over here December 18th. I remember this day very clearly because I happened to be doing the closing bell ceremony at the NASDAQ, and what had happened here, you get some follow through, you get a big move up, you get big move down, you get a move up, big move down, ramp, new highs, and then we all of a sudden sold off. This is volatility, right? So this creates a lot of two-way sided trade. Works really good for people that are shorter term traders, day traders, but swing traders tend to get stopped out now, and you just got to be a lot more diligent as far as swing trading goes. Because a lot of price action that gets tight, when it breaks out, you get a lot of fake outs, shakeouts, whipsaws, and that's just how the market conditions are currently shaping up to be, which we'll dive into here shortly a little bit more specifically. If I just look at SPY on the weekly time frame or SPX on the weekly time frame, we have been noticing that the histogram here on the MACD has been kind of just losing its self momentum. You can see the MACD is starting to curl over, but overall, what does this down week look like, right? We're down 2.43%. It doesn't look like much, right, at all. quite literally, it doesn't look like anything, but it doesn't mean that it can't turn into something. So that once again, if we just pull back further to and around that 6,200, if that is the case, you'd be pulling into the 40-week moving average, which is roughly the 200-day moving average. And that would also be in confluence with the prior highs here. So if for whatever reason we get some follow through, more scare to the downside, I would prefer it to be fast and quick. Something like we've seen in the past, like right over here in February, right? And right over here in 2020, that would be, a little bit more my speed. But, sometimes, if we go into more prolonged bear markets, it can look more like this, where you get, moves to the downside, but then you get rips back up. Everyone gets excited. It sucks people in, boom. And you typically have these like 3 waves, right? You get a wave down, another wave down, and another wave down before you start to finally find divergences, right? Positive divergences in various internals and sentiment and so forth. Okay. So this is just the start of something that could potentially turn into something more. And we just got to be prepared for that. If I look at a daily time frame, we did break through this channel. Okay, this is obviously was going to happen. We knew this was going to happen at some point. We're at that lower Bollinger Band, right? If market wants to continue to press lower, like we said, there's some levels down here that we can pay attention to. Typically, what happens is you get a back test of these channels. So at some point, maybe we do come back up to 6,700. We'll see what it looks like. If it does, maybe it just takes another Trump tweet, and then the market's all healed and good, right? We don't know yet. But what we do know is what the market's pricing in for risk. And that's the most important thing that we can really utilize, right? So last week, the market priced in $9.58. We actually closed outside of it. Not like crazy, but this would probably be one of the bigger closes this year outside of this one. So there's been basically 2 closes this year outside of the weekly implied move that were kind of substantial. Most of them, the closes outside were basically this, right? And this little one and this little one, which is basically right on the money, and in my opinion. But once you have these breaks, it is a little bit more concerning, and it shows actually a substantial move. Now, because of this big day, what happened to volatility as far as the expected move goes? Now it jumped to $16. That's plus or minus, right? Plus or minus $16, which can bring us up to basically 670 to the upside, which would be back testing kind of these little lower wicks down here. And if we get some follow through to the downside, the market can potentially come into confluence of 640.69, slightly lower, which would be the weekly implied move and the month to date. Now, if we just slam down here come Monday, this is, that would probably freak out a lot of people, a lot more bearish talk, but at least we would know that, hey, this is what the market priced in for the month of October. So nothing really is outside of the normal. And if it happens on Monday and comes down here, we'd also say, well, that's what the market priced in for the week. So there's nothing abnormal actually really about this. Now, if we get some crazy sell side and we come down to the quarter date expected move, that's 617.04. That's where I always prepare for longer term purchases. If we just slam into the quarter to date move early into the quarter, or midway into the quarter, those are typically good opportunities to get some exposure in the market. It doesn't mean you can't go lower, but it's been, since I've been tracking these, a good opportunity. Okay. Now, that's to say if it were to go lower. If it obviously were to go higher, right, we'd be paying attention to these levels up here. But after a substantial break like this on volume, it's typical to get follow through and or an inside trading day the following trading session, which is going to be Monday. Now, the last time we had an expected move this big, we previously discussed it, right? It was over here in April going into May. And what I found so interesting about this expected move, which was plus or minus $16.85. I know it's hard to see, but what actually happened this week is we got follow through to the downside and it came all the way back up and closed to the upside. That is some intense volatility. So, in layman's terms, if we were to see something similar, that would be a huge, right? A move down to 640 and then back up to 670. I don't think anybody is preparing for anything like that. But what I will say is that would be within market expectation. It's crazy as that is, but it would close within that range of risk. And I'm not predicting that that's going to be the case. But remember, 70% of the time this year, right? 70% of the time, which we've been stating, we have tagged the expected moves, okay, of the week. So if you just look back on this chart, so 70% of the times we tagged and or exceeded. So we tagged, no tag. So no tag over here, we tagged, no tag over here, tag, right? Tag, boom, tag, boom, tag, boom. Okay, so out of all the weeks that I'm just displaying here, there was just 2 that we had no tags. If I go back for the last quarter, which I've shared many times on this channel, 70% of the time, which is one standard deviation of risk, basically slightly higher, okay? So yeah, I would be prepared for us to tag one of these expected moves. So be prepared for, $160 plus move in the S&P 500, the SPX, or $16 move here in the SPYs. There's a 70% probability that can be the case. Now, this is where market conditions kind of come into play and how things, if you don't adjust your strategy, things can really get haywire. This bar right here just tells us that as far as net gamma history goes, we are now entering into a period of negative gamma. Sometimes we see little pops in negative gamma, right? And then it gets quickly fixed. However, there are some cases where we stay in negative gamma for a while. And that happened to be the start of February or mid-February into basically mid-April. And what happened there? Well, the S&P 500, as we know, that was right here, went through some big volatility two-way directionally. Because that's what happens. When you're below the gamma flip line, meaning negative gamma, dealers will sell into the selling, they'll buy into the buying, and you get wider range moves in the market. And you can see that here on the VIX, right? The VIX, I'm highlighting here in gray, right? I'm using just CBOE market volatility VIX. It's probably smarter to look at VIX futures, but this is just for display purposes. What I'm highlighting here is the times that we're in negative gamma. And I want to be very clear here because the episode was titled, this could get worse. And this pop, right, is it going to get faded and come back in? Maybe, perhaps. But could it potentially turn into something like this? And that's where I want to talk more about systematics because, yes, it can turn into something more. It has the potential to do that. And the market conditions are kind of aligning for something potentially bigger to occur in these markets. I don't want that to happen, right? I'm a long-sighted trader. So not only did, by the way, so people are wondering maybe how I traded this, like I've been saying, last week, 2 weeks of episodes, I've been sharing my portfolio. I've been going into bigger cash positions, but still I was taking on new long positions if they made sense. So my portfolio was still down on Friday, but it wasn't as bad as the S&P 500 and definitely not as bad as the NASDAQ 100. So, I'm thankful for that. Okay. So the reason why it could potentially turn into something like this is because of vol control funds, systematics, and risk parity funds. So if I share with you vol control funds, I want to share with you kind of where we are now, right over here. And in short, these are just, these are vol control funds, vol control position. These are funds that you can monitor, you can track to see when they become potentially bigger buyers or bigger sellers, and this can really add volatility into these markets. So I guess I like to share more instead of trying to juice it up with jargon is to share with you just the visuals, right? So when we were a pretty frothy area over here. This happened to be February of 2025. So the reason why I'm highlighting is because when vol control funds, when it starts to go down like this, they can really add emphasis to the sell side that you see in the S&P 500. Okay, so this was in February. And then over here, right, when we talked about where vol control funds can become potential buyers, right, net buyers, and it can help the market, this was in April, mid-April, and then going into May. Okay, but we didn't only talk about it, obviously, then we didn't talk, or just vol control funds, we were talking about CTAs, commodity trading advisors, right? They'll sell into weakness, they'll buy into strength, right? They're just basically following trend, algorithmic, at this point, right? And as you can see, we are at a pretty frothy level here too. And then at the bottom of February, right? Or sorry, not the bottom of February, bottom of April in the S&P 500, we were talking about how they can become, net buyers and really help perpetuate this market to the upside. And then right before February, right, it was actually not like crazy, but it did help, add to that sell side in the S&P 500. So when I shared this chart here, right, what I'm highlighting is vol control funds when they become sellers, right? And then they become buyers over here, which help the market, right? When CTAs became sellers, right, they help bring the market down. But when they became buyers, things changed rapidly. So it's important to just note and call out, they're at elevated levels right here. So if we remain in negative gamma, which we've been talking about, right? Once we flip to negative gamma, we said that these guys can become sellers, net sellers, right? And it could add to the propensity of a downside move. And that is exactly what we saw. And now if they continue to be sellers, if the market continues to perpetuate to the downside, it can get more aggressive, right? It's not going to be one quick shot. Typically, it's not one quick shot. Usually you get a burst up and people, it sucks people back in and then you have to deal with that, right? But they're still at an elevated level. CTAs are still at a really elevated level. So if they become net sellers, it can really do some damage into these markets. And then when it comes down to these, significantly lower levels down here, I'll be first to talk about it, once again, at these lower levels here, if it were to occur. Now, if we look at overall gamma perspective, 6,800 still remains to be the call wall, but you can see there has been some shift in put positioning. As you can see here, 6,400 now is the put wall. Okay, so downside, if we get continued downside from a gamma perspective, 6,400 would be a level to watch. Now, the gamma flip line is roughly at about 66.75. Once we cross through that, right, selling into selling, buying into buying, you get more volatile price swings. That's exactly what, had happened. Now, to continue this, right, you want to, if you want to see this two-side trade and more volatile price swings, it's going to typically occur while we're under this gamma flip line, as I previously stated. So be very aware that when we're underneath the gamma flip line, strategies change, right? Typically for me, I like to, day trade more frequently under a gamma flip line because you get two-sided price action, right? Or you get more pronounced swings intraday. Now, from a swing trading perspective, which is primarily what I do, I take less positioning from a breakout perspective because there's a lot more fake outs and whipsaws, and my positioning size tends to reduce now. And then if some names that have been beaten down significantly, right, and just get these crazy moves to the downside, I like to look for key levels to buy into for a fade trade. And still, by the way, those are typically, if I'm fighting the trend, they're less in position size, so smaller position size, and I'm typically a little bit more aggressive to take profits. Okay, so my strategies shift when market conditions shift. Going into next week, the SPX 6750 would be the upper weekly implied move. So if we come all the way back up here, we're back above gamma flip line, we're back up here at the weekly implied move. That's what the market's pricing in for risk. That's a possibility. Okay, to the downside, we have 6355, which happens to be the long puts of the JPM caller, which is at 63.30. That's also right next to the obviously lower weekly implied move. The daily implied move is 64.31, which is basically sitting on the month-to-date implied move. So any move down into this area, right, would be great areas to look for potential bounces and some reliefs. So if we get some follow through, I'd be looking for maybe 50 to 61.8% retracements, something like that, right, and see what it does from those points. But we need more data, obviously, to prepare for that. Another thing to look for is back month versus front month volatility. This chart, right, when we start to get back into these, these extended levels, you got to be more cautious because you can see pullbacks in these markets or consolidation. So over here, what did we see? We saw the market, we saw back month get ahead of front month by over 20, almost 25% there. And that's, a place where you don't really want to go long the market. You want it to consolidate, pull back, and so forth. And we went down a little bit from that point. Then we kind of went up higher. And then today we had some follow through. Now, from a buy the dip perspective, if we start getting under 1.0, this is typically an area, and there's been some dramatic ones these prior times over here, but that's typically where you can find some lows in the markets or periods of consolidations where you can see some potential bounces. So even over here, right, where we had that sharp move, all the way down, we saw a nice bounce up. Over here, boom, nice move up. Over here, we went up, but then we, kind of went down there. And then over here, same thing, right? We found this low, bounced a little bit this low. Obviously, that was a pretty aggressive one. So if we start getting underneath this 1.0, that's where, if you're short the market, you can potentially look for covering some and just be prepared for the market to consolidate and or bounce a little bit. Not there yet. Another thing to why things could potentially get worse is we just had the November, December contracts of VIX futures go into backwardation. So what that simply means is we got problems here and now versus out into the December contract. Now this could obviously can get significantly worse, which we saw in February. It's not crazy right now, but we're talking 2022 and in November VIX reading, and in December we have 21.8. So it's a clear backwardation between these two contracts, just letting us know once again that hey, we got volatility here and now. What you want to see is it just go like this, right? That's just telling us that hey, things are good. Yeah, in the future we see risk. That's always going to be the case. But all of a sudden, when all of a sudden risk is here right now, well, that's what we're seeing, and this is very common to occur when you go underneath the gamma flip line. Okay, so once again, why can things get worse? I want to reiterate this before we go into the signal charts. Things could get worse because one, we're in negative gamma. Two, just looking at where the perspective of vol control funds are in CTAs, okay? And then we have some obviously signal charts that aren't really actually frothy levels right now, right? And I'll go into those here coming through. And then the next piece why it could potentially get worse is just the expected moves have gotten a lot larger. So it's important to be aware of what the market is pricing in for risk. Okay, if we look at the direction of the 5-day moving average amongst all of these, biotech surprisingly hold it up just fine, but yes, SPY, Qs, IWM, semiconductors, and DIA, they're all in the red. Yeah, this is frothy to the downside. So what you want to do, just be aware, you can anchor a VWAP. I did right here on the SPY and the Q. These are the all-time high VWAPs, I believe, and they're also kind of when Trump did the tweet. So it's going to be an important VWAP. And that is kind of just watch that level because it is declining. So if price action wants to get back above it, that could be actually a more positive note where we get some more relief. But if you want to be more patient, wait for the direction of the 5-day moving average, right? Wait for that to start to flatten out and turn back up. Okay. That's, would be a way to keep yourself out of danger. But yeah, typically moves like this, frothy. Yeah, like I said, you'll probably get some sort of follow through, right? It's very common to see that, but it's also very common to get a gap up in just an inside trading session. And if we come back up, right, even if we were to bounce, in these products, just pay attention that the direction of the 5-day moving average, it still needs to change. So the trend from the shorter term perspective is changing as we speak, okay? If we continue on and look at the 10-year yield and oil, we'll look at some of the intermarket assets. Oil absolutely got clobbered. I think was down like 5% or so. The 10-year yield went with it, which I think on the last brief, we discussed how this could be positive for bonds, which we'll cover. But yeah, 10-year yield has a pretty big hit to the 10-year yield. If we look at oil, big hit, right? Oil typically leads the way there, so minus 5.33%. That just not a great look over there. And then TLT, right? We can potentially be considering that flight to safety. That was up 1.61%, so a big blast off there. The dollar backed off slightly, but the dollar has been trending higher. We've been watching watch for the dollar, watch the 10-year yield because, when they rise together, it's been typically negative for the S&P 500. And the S&P 500, since this kind of change in trend with the dollar and the 10-year yield, right, you can see the S&P 500 it's down slightly, kind of gone nowhere. The dollar or the 10-year yield is slightly up, pretty much flat too, just like the SP 500. And you can see the dollar has been kind of making its way higher. And these type of moves from an intermarket perspective, as we've been tracking and watching, have had effects on the market. If we take a look at gold, gold was slightly big here too, just kind of consolidating that big, big red day over there, if you want to call that big, but overall, it was a pretty decent sized day. And that was an inside trading session there on gold. There's been a rotation into gold relative to the S&P 500. There's been a rotation in utilities, right? Which is a warning sign in and of itself. Recently, right, we saw healthcare start to outperform a little bit. Defensive names, not really at all. TLT started to get above its 50 EMA on that relative strength line, and consumer staples has been pretty beat here too. So we've been seeing some rotation into safety names, and we haven't, you don't know why. And all you know is that if there's a catalyst that hits, it's going to look a lot more obvious in hindsight. Okay, so we've been seeing rotations into some of that, more of the safety dynamics of these markets. If we look at breadth of the market, you can see here that, this is another reason why things could potentially get worse. It's not like it's an oversold condition if we look at the percent of stocks above the 20-day, 50-day, and 200-day moving average in the S&P 500. When we get actually, stronger sell-offs, bigger moves, bear markets, etc., you get significantly more, oversold condition readings. So the 50-day percent of stocks above the 50-day, right? As the market's been pressing higher, we've been talking about how this has been going down, but it's still not like it's a frothy reading like it was over here at the bottom of, the 2025 low, right? And then over here for the 200-day, like these both got hammered. And as you can see, still, 56% of the stocks in the S&P 500, they're still above their 200-day moving average. So that's, that's pretty fairly neutral. 50-day moving average, only 38% of the stocks in the S&P 500. So that's getting a little bit more frothy to the downside, but it's not by any means super extended to the downside. So it typically goes 20-day first, then 50, then 200, obviously when you're in a bull market and price has been rising. So we'll continue to watch that. Now, if I zoom out further and we look at percent of stocks above the 20-day moving average, but in different index products like NASDAQ, NASDAQ 100, Dow Jones, S&P 100, 1500, mid cap, small cap, and the S&P 500. Really the ones that are moving into oversold condition would be the small caps, and then the mid caps are nearing. Okay, so yeah, these ones are getting a little bit more frothy, but the other index products, they're moving, but they're not quite that oversold yet. If we take a look at the percent of stocks above the 50-day moving average in those same index products, nothing's really oversold either, okay? That's, one of the reasons why, if you really want to buy a good dip, it's nice to see everything kind of all in alignment, and it's not really there yet. Right? It's not there, and it might not get there. I don't know. Now, if we look at the bullish percent chart on the technology sector, it's not oversold yet, but hey, it was overbought. We talked about it when it's overbought. Then you look for it to be oversold. You look for potential positive divergences to form. Well, there you have it. It's been coming off. It's sold off a little bit. If we take a look at the bullish percent index for consumer discretionary, this one we showed on yesterday's show, and we talked about how we might get a rotation into some of the names that have just been getting hammered on this sell-off, because consumer discretionary, like the main names, right, was, what do we go over? Tesla and Amazon. And those names have been doing, fairly well, good, but some of the internal names of what's causing this to sell off so much much were getting hit. So some of the names we talked about was like Home Depot, right? So Home Depot still went down yesterday or on Friday's trading session, but it went down significantly less than the S&P 500. It was down like 0.5%. McDonald's, right? It's kind of a consumer staple as well. And we discussed consumer staples as well. Many consumer staples finished up. McDonald's was one of those names that did finish up. Okay, so I'd still be looking for potential rotations to take place in these markets, and those could still all be some very good names. So if you didn't watch yesterday's episode, make sure to do so, or just look at the top, holdings of these ETFs. Now, another reason why I say, yeah, things could get worse is if I'm looking like a larger, significant sell-off, I like to look at, costs of the CPC, which I previously showed on the last episode. And then I also like to look at it compared to skew. And then you have the S&P 500 down here. So when you get like significant moves to the downside, like at the bottom of bear markets or the bottom of crashes like the pandemic, something is very apparent that occurs. And that happens to be when you look at the put to call ratio, you typically have the 10-day moving average of the put to call ratio well above 1.0. Okay, that just tells you that things are, the sentiment is incredibly bearish, right? So over 1.0, incredibly bearish, and you start to look for it to turn back around to potentially buy the dip. Okay. Now, if you pair that with something like skew, right? Let's just think of this as, hedging protection, like, right? People get more fearful, I guess, like hedging protecting as higher it goes, thinking that, hey, something could potentially happen. But then the lower it goes, hedges are coming off, things are too bearish, right? You start to look for those dips. And if you pair this thing together, like for example, if you look at the pandemic, take a look at where skew got. Skew got under 115, which is, historically more low. And then this shot way above 1.0. And that happened to be what? The bottom of 2020. If you come over here, look when skew was over here at 115 and under it. And then you have what? The market, or CPC, total put to call ratio, the 10-day moving average, well above that 1.0 here too as well. Okay, and there's been times where you also see it, above 1.0, not quite down to those levels, but yet this was, you still saw good pops in the market, but remember, you get those potentially 3 waves down, and we went through that larger bear market. More recently, right, we got down to around 125 on the skew, but then this put to call ratio went well above 1.0. That happened to be the bottom over here of peak bearishness, right, of 2025. And if I look where we are now, I mean, we're at 0.8 or, just slightly above it. And on yesterday's episode, we talked about this is where you want to be actually more cautious, right? This is a more cautious tone of the market because everyone's so bullish. So down at these levels under 0.8, that's when the sentiment is, more bullish. And you might look over here, well, it can stay down there for a while. And I'd say yes, but also remember after 2020, what did we have enter in? We did see volatility still, big moves, but we had the backstop of the Federal Reserve too, firing off a bazooka at the bottom of COVID in 2020. Okay. And if I look at skew did come off down here to 140, but it's still not like, down into these lower levels, and put to call ratio is not there either. So if the market were to turn into something bigger, I would be looking for a move of the put to call ratio above that 1.0, 10-day moving average of the put to call ratio. And then I would expect skew to come off more as well. And then I'd feel a little bit more confident saying, okay, if you're trying to short down here, if you're getting overly bearish, this is an area where you do definitely want to pay more attention to and wipe the fear aside and start to actually prepare for changes in these markets. The NYSE summation index over here, the NYSE summation index right here, and the NYSE McClellan oscillator, I like to pair these together. We had a potential change in trend over here, and the market kind of just went, a little bit higher, but it continued to trend lower, which was just diverging to price action, and now kind of caught up. And as price was going up higher too, we've been noticing the divergence that was taking place in the NYSE McClellan oscillator. So once again, this is, getting into no oversold condition, but more, minus 250, minus 300 or more aggressively oversold conditions historically with this indicator. And another interesting historic thing that I don't have the chart for, but if you get the NYSE summation index to cross below 0, the same time that you get a NYSE McClellan oscillator reading of minus 300, so like pretty close together, it's not been good for these markets, right? And if you see, like, for example, right over here, it actually happened, it occurred. And what did the market do, right? The market went, sideways, it went a little bit higher, and then we went into, obviously, all the sell side that we saw in February. And if you go back in the past, you could see it like 2018, before 2020 and so forth, this actually did occur as well. And it was a big warning sign to the internals of the market. So we'll continue to monitor that if that were to occur. Another thing that we were talking about that I shared on Twitter, it's mattered in the past. I forgot to share this chart in the last brief, but I did post on Twitter that, if you look at high yield, this is considered the smart money, right? And then you got the SPY down here, which is the dumb money, right? Don't take offense to it, but the bond market's bigger, it's larger, and you got smarter players in it. So when you start to see shorter term divergences build, it's both from a bullish and bearish perspective. That's why I'm bringing it up now is, well, you had a high yield start to go lower. You had the SPY, start to go higher. And as you can see, what happened? Well, SPY just the other day caught to the downside. Now, from a flip perspective here, now if all of a sudden high yield starts bouncing and puts in a higher low like this, but yet the SPY, puts in a lower low, I would be paying very close attention to that as well, because it's telling us that there's a shorter term perspective in high yield is actually moving up and SPY is actually moving lower, which could indicate that, hey, it might be the time that smart money is, betting on higher yield, and SPY could very well benefit from that. So that's what I would be paying attention to there. Because one gave us insight to this recent move too. Now, just heads up, notice we're coming into earnings season. Financials kick it off. So hey, if everything's good here in the financial sector, maybe that's what we need to bring this market back up. We got on Tuesday before the open, we got JPM, BlackRock, Goldman Sachs, Wells Fargo. The financials are typically always the first ones to report. And then obviously in a couple of weeks, we'll have the big mega cap names reporting as well. Thursday, we have TSM, right? So there's some big names. It's the kickoff to earnings season for Q4. Be prepared for that. Another note is that the Bureau of Labor Statistics, BLS, they said that they're going to publish the CPI on Friday, October 24th. At 8:30 Eastern Standard Time. So we'll be on the lookout for when that occurs. We still got some time, and we'll update as we get more market briefs out. But that's something to just be aware of, that is set to actually come out during this government shutdown, which will end at some point, hopefully here in the near future. So hope today's episode helped out, mapped out some key levels, explain as to why this could get worse, but more importantly, what the market's pricing in for risk and how the conditions of the market change, strategy, and so forth. There was a lot to take in. So if you need to, take notes, ask questions, and I'll try to do my best to answer them in the comments. See you later.